On July 2, 1997, Thailand made a single decision that would destroy $600 billion in wealth across Asia. Within 6 months, Indonesia's currency lost 83% of its value. South Korea, one of the world's strongest economies, needed a humiliating $57 billion bailout just to survive. Major corporations that had existed for decades collapsed overnight. Millions of middle-class families across Asia watched their life savings evaporate. Construction cranes froze mid-air above half-finished skyscrapers that would remain empty for years. This wasn't supposed to happen to the Asian tigers, the economies everyone said would dominate the 21st century. But it did happen, and the story of how a single currency decision in Thailand triggered the near collapse of the entire Asian economy is one of the most important financial lessons most people have never fully understood. Today, you'll learn exactly how prosperity turned to panic, why nobody saw it coming, and most importantly, what this crisis teaches us about the warning signs hiding in today's economy. If you want to understand the economic forces that shape our world, the stories that happened while most of us were sleeping, please hit that like button and subscribe to The Sleeping Economist. Click the notification bell so you don't miss our next deep dive into the financial events that changed everything. Chapter 1. The Miracle Before the Meltdown. To understand how Asia fell so hard, you first need to understand how high it had climbed. In the early 1990s, Southeast Asia was the envy of the world. Countries like Thailand, Indonesia, Malaysia, and South Korea were growing at rates that seemed impossible, 8%, 9%, even 10% per year. To put that in perspective, when the US economy grows at 3%, we call it a boom. These countries had discovered what seemed like a foolproof formula for success. They kept their currencies pegged to the US dollar, which means they artificially maintained a fixed exchange rate. Think of it like this. If you're Thailand, you're basically promising that your baht will always be worth a certain amount of dollars, no matter what. This made foreign investors feel safe because they knew exactly what their investments would be worth. And the foreign money poured in like a waterfall. Japanese banks, American hedge funds, European pension funds, everyone wanted a piece of the Asian miracle. Between 1990 and 1996, private capital flows to developing Asian countries increased from $20 billion to $256 billion. That's like going from earning $20,000 a year to suddenly making $256,000. But here's where things get dangerous. Most of this money wasn't going into factories or technology or education. It was going into real estate and stock market speculation. In Bangkok, new office buildings were going up so fast that by 1996, the city had enough empty office space to house every single office worker in the country, with room to spare. In Malaysia, they were building the world's tallest buildings. Everyone was betting that the growth would never stop. The governments loved it because all this foreign money made them look like economic geniuses. Their citizens were getting richer, at least on paper. A middle-class Thai family might have seen their home value triple in just 5 years. Companies that had never made a profit were valued at billions of dollars. It felt like free money. But there was a ticking time bomb hidden in all this prosperity. Most of these loans were what we call short-term foreign currency debt. In simple terms, Asian companies and banks were borrowing dollars and yen that they had to pay back quickly, usually within a year. They were using this borrowed money to invest in long-term projects like buildings and factories that wouldn't generate returns for years. It's like using your credit card to buy a house. As long as you can keep getting new credit cards to pay off the old ones, you're fine. But what happens when the credit cards stop coming? Chapter 2. The cracks begin to show. This brings us to 1996, when the first warning signs appeared, though almost nobody recognized them for what they were. The problem started in an unexpected place: the United States. The US dollar began strengthening against other major currencies. Since Asian currencies were pegged to the dollar, they got stronger too, automatically. Now, a strong currency sounds good, right? But for countries that depend on exports, it's actually a problem. Suddenly, Thai products became 20% more expensive for Japanese buyers, not because the products changed, but because of currency values. It's like if you were selling lemonade for $1, and overnight, without you doing anything, Your lemonade now costs $1.20. Your customers are going to buy less lemonade. Asian exports started slowing down. But the governments couldn't just devalue their currencies because, remember, they had promised foreign investors that the currency pegs would hold. Breaking that promise would cause panic. Meanwhile, those empty buildings in Bangkok weren't finding tenants. Real estate developers who had borrowed millions to build skyscrapers couldn't pay back their loans. Thai banks started accumulating bad debts, loans that would never be repaid. By late 1996, Thai banks had about $30 billion in what we call non-performing loans. That's banker speak for money they'd never see again. The Thai government tried to hide the problem. They used their foreign currency reserves, basically their national savings account, to prop up failing banks. They spent billions maintaining the currency peg, buying baht with dollars to keep the exchange rate fixed. It was like trying to hold back the ocean with your bare hands. Foreign investors started getting nervous. Hedge funds, led by famous traders like George Soros, began betting against Asian currencies. They would borrow baht, immediately exchange it for dollars, wait for the baht to fall, then buy back the baht cheaply to repay the loan, pocketing the difference. The more people did this, the more pressure it put on the currency. By early 1997, Thailand was spending $1 billion per month just to maintain the currency peg. Their foreign reserves dropped from $38 billion to $2 billion. They were running out of money, but admitting the problem would cause the very panic they were trying to avoid. The International Monetary Fund, think of them as the world's emergency economic doctors, started quietly warning that several Asian countries were in trouble. But publicly, everyone maintained the fiction that everything was fine. Finance ministers gave confident speeches. The World Bank praised Asian economic management. It was like watching someone's house burn while they insist everything is under control. Chapter 3. The Day the Music Stopped. On July 2, 1997, Thailand finally gave up. They announced they would float the baht, which means letting the market decide what it was worth instead of artificially maintaining its value. Within hours, the baht fell 20%. Within weeks, it had lost half its value. To understand the chaos this created, imagine waking up to find that your $100,000 savings is now worth $50,000. Your $200,000 mortgage is still $200,000, but your salary just got cut in half. That's what happened to every Thai company that had borrowed in dollars. The panic spread faster than anyone imagined. Investors suddenly realized that if Thailand had been lying about its economic health, what about Indonesia, Malaysia, South Korea? Within days, what traders called contagion had begun. Money fled Asia like people running from a burning building. Indonesia was hit the hardest. The rupiah went from 2,400 to the dollar to 14,000 to the dollar. That's an 83% collapse. Imagine if the US dollar suddenly became worth 17 cents. That's the scale of devastation we're talking about. But here's where it gets really interesting. South Korea wasn't supposed to be vulnerable. This was the 11th largest economy in the world, home to giants like Samsung and Hyundai. They had joined the Rich Countries Club, the OECD, just a year earlier. But Korean companies had borrowed $160 billion from foreign banks, most of it due within a year. When foreign banks refused to roll over these loans, meaning they wanted their money back instead of extending the deadline, Korean companies started failing like dominoes. Banks collapsed. The one lost half its value. The country that had hosted the Olympics just 9 years earlier had to go begging to the IMF for the largest bailout in history, $57 billion. The speed of the collapse shocked everyone. Malaysia's prime minister blamed George Soros and evil currency speculators. Indonesia's president, Suharto, who had ruled for 31 years, was forced to resign as riots erupted in Jakarta. In South Korea, citizens lined up to donate their gold jewelry to help pay back the national debt, a heartbreaking symbol of how personal this crisis became. Stock markets across Asia fell 70%, 80%, even 90%. The Jakarta Stock Exchange lost 91% of its value. Hong Kong's government spent $15 billion of public money buying stocks to prevent complete collapse. Singapore, despite having strong fundamentals, saw its currency and stock market plummet simply because it was in Asia. Chapter 4. The Rescue That Came with Chains. This is when the International Monetary Fund stepped in with rescue packages. But IMF help came with conditions that many Asians still consider humiliating. Countries had to raise interest rates to 20%, 30%, even 40% to attract foreign money back. Imagine trying to run a business when borrowing money costs 40% per year. They had to cut government spending exactly when their people needed help most. They had to let failing banks and companies collapse, even if it meant millions of job losses. They had to open their economies to foreign ownership, allowing Western companies to buy prized national assets for pennies on the dollar. Indonesia received $43 billion but had to close 16 banks immediately. The panic this caused led to runs on healthy banks. South Korea's bailout terms required them to lay off workers and sell major companies to foreign buyers. Thailand had to float its currency and watch helplessly as inflation made basic goods unaffordable for ordinary people. The human cost was staggering. In Indonesia, poverty rates doubled overnight. 13 million people lost their jobs across the region. In Thailand, 56 finance companies collapsed. Construction workers who had come to cities for jobs walked hundreds of miles back to their villages because they couldn't afford bus fare. The social fabric tore apart. In Indonesia, ethnic tensions exploded into violence. Middle-class families sold their cars, their jewelry, even their homes just to buy food. Students who had been studying abroad were called home because families couldn't afford tuition. A generation's dreams evaporated in months. What made it worse was the speed. Unlike the gradual decline of a recession, this was economic freefall. Companies that were profitable in June were bankrupt by December. The psychological trauma was as severe as the financial devastation. The confident, rising Asia of the early 1990s was replaced by societies questioning everything they had believed about their economic miracle. Meanwhile, the crisis spread beyond Asia. Russia defaulted on its debt in 1998. Brazil needed a bailout. A major U.S. hedge fund, long-term capital management, collapsed and needed rescuing. The Asian flu, as traders called it, had gone global. Chapter 5. Rising from the Ashes. But here's what's remarkable about the Asian financial crisis. The recovery was almost as swift as the collapse. By 1999, most Asian economies were growing again. South Korea paid back its IMF loan 3 years early. Thailand reformed its banking system and became stronger. Even Indonesia, the hardest hit, eventually recovered. How did they do it? First, the currency devaluations, as painful as they were, made Asian exports super competitive again. A Samsung TV that had become too expensive was suddenly cheap for American buyers. Tourism boomed as Western visitors found their dollars went twice as far. The medicine was bitter, but it worked. Second, the crisis forced real reforms. Banks had to report their true financial condition. Governments created better regulations. Companies that had relied on political connections had to become genuinely competitive. The phrase crony capitalism, where success depends on who you know rather than what you produce, became toxic. South Korea used the crisis to restructure its entire economy. They broke up the chaebols, massive conglomerates that dominated everything. They created a more transparent financial system. They invested heavily in technology and innovation. Within 5 years, South Korea had gone from near bankruptcy to becoming a digital powerhouse. But not all lessons were learned. Many argued the IMF's medicine was too harsh, that forcing countries to raise interest rates during a panic made things worse. Malaysia proved this point by ignoring IMF advice, implementing capital controls instead, and recovering just as quickly. China, which maintained its currency controls and avoided the worst of the crisis, became convinced that financial liberalization was dangerous. The crisis fundamentally changed Asia's relationship with the West. The humiliation of having to accept Western money with Western conditions created a determination to never be vulnerable again. Asian countries began accumulating massive foreign currency reserves as insurance. China now holds over $3 trillion in reserves. They learned that in global finance, you're either the creditor or the debtor, and it's much better to be the creditor. The crisis also accelerated Asia's economic integration. Countries realized they needed to work together, creating currency swap agreements and regional financial arrangements. The crisis that nearly destroyed Asian economies ended up making them more united and resilient. Chapter 6. The warning signs we can't ignore. Today. So what can regular people learn from a crisis that happened nearly 3 decades ago? More than you might think, because the same patterns keep repeating, just in different places with different names. First, beware of economic miracles. When everyone agrees that some country or sector can only go up, that's exactly when you should be worried. The Asian tigers of the 1990s became the cautionary tales of 1997. Today's unstoppable tech giants or cryptocurrency miracles might be tomorrow's crisis stories. Second, debt in foreign currency is dynamite. Whether it's countries, companies, or individuals, borrowing in a currency you don't control is incredibly dangerous. If you're an American with a mortgage in Japanese yen and the dollar falls against the yen, your debt just got bigger even though you did nothing wrong. Third, watch for these warning signs. Rapidly rising real estate prices, everyone becoming a real estate investor, banks lending money too easily, and governments insisting everything is fine when numbers suggest otherwise. These patterns appeared before the Asian crisis, before 2008, and they'll appear before the next crisis. Fourth, contagion is real and it's fast. In our connected world, a problem in one country can become everyone's problem within days. When Turkey's currency collapsed in 2018, emerging markets from Argentina to South Africa felt the impact. When Silicon Valley Bank failed in 2023, banks in Europe wobbled. Fifth, having savings in your own currency, avoiding too much debt, and not chasing investment miracles isn't boring, it's smart. The Thai families who lived modestly came through the crisis better than those who leveraged everything to buy condos. The Asian financial crisis teaches us that economic gravity always wins. What goes up too fast will come down hard. Countries that seemed invincible became beggars. Currencies that seemed stable collapsed. The impossible became inevitable, and it happened faster than anyone imagined. Today, we see similar patterns. Unprecedented debt levels, asset bubbles in everything from stocks to real estate, and the confident assertion that this time is different. But this time is never different. The names change, the locations change, but the fundamental pattern remains. Too much borrowed money chasing too few real opportunities always ends the same way. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel because we're just getting started with these financial educational mysteries.